Welcome to the channel. In today's video we going to look at how to value a stock. In investing there are a lot of valuation method that investors use to break down a stocks. In this video, we will look at 5 commonly used financial ratios to value a stock, which are the price to book ratio, price to earnings ratio, price to earnings growth PEG ratio, dividend yield, and the discounted cash flow method. These financial ratios are powerful tools to can help investors to summarize and understand companies' financial statements. Before we start the video, please hit the like button and the subscribe button to support the channel. And don't forget to comment down any topic you want to be discussed in this channel. Now we are going to start with the price to book ratio. This valuation tool is easy to use and can be found in many stock market screeners. Firstly, what is the book value of a company or a stock? Book value represents the value of a company. If we were to sell all the asset and pay all the liabilities today, the leftover value is called as the book value. This is very useful to know, because many companies in mature industries doesn't deliver high growth numbers like Amazon or Tesla, but they can still be a good value-based investment if we buy below their assets value. The book value usually includes equipment, buildings, land, and anything else that can be sold, including stock holdings and bonds. But investors must make assumption correctly, just like any other investing method, because wrong assumption in asset value can lead in overpaying for stocks. For example, with financial stocks, the book value can fluctuate with the market, as these stocks tend to invest their capital into a portfolio of assets that goes up and down in value. Moreover, for industrial stocks, they tend to have a book value based more on physical assets, which depreciate year over year according to accounting rules, losing its value over time, for example, equipments. In either case, buying a stock with low price to book ratio can protect you from downside, but remember, only if it's accurate. This means an investor must look deeper into the actual assets underneath the stock. Furthermore, price to earnings ratio. This ratio is possibly the most used of all the ratios. When a stock goes up in value, without any significant earnings increases, usually it is because of PE ratio expansion. It means a lot of investors are paying higher multiple of earning for the same stock. The reason for such a behavior is because of growth prospect that stock have given investors in the past, giving confidence to investors that the high PE multiple will be justified by the future earnings. But be careful with paying high multiple of earning for stocks, because without earnings to back up the price, a stock will eventually fall back down. Other important tips for using this method for valuation is that investors should only compare PE ratios among companies in similar industries and markets. This is because companies for different industry and markets have different growth rates. To simplify the matter, PE ratio can be thought as how long a stock will take to pay back your investment if there is no change in the business. A stock trading at $20 per share with earnings of $2 per share has a PE ratio of 10. Which means that you'll make your money back in 10 years, if nothing changes. An investor may buy a stock with a PE ratio of 40, if they think it will double its earnings every year, shortening the payoff period significantly. If this fails to happen, the stock will fall back down to a more reasonable PE ratio. If the stock does manage to double earnings, then it will likely continue to trade at a high PE ratio. Next, let's look at price to earnings growth, or also known as the PEG ratio. Instead of merely looking at the price and earnings, this ratio incorporates the historical growth rate of the company's earnings. What does this mean? Well, let's say we want to know how company A's stock stacks up against company B's stock. The PEG ratio is calculated by taking the PE ratio of a company and dividing it by the year-over-year growth rate of its earnings. The lower the value of your PEG ratio, the better the deal you're getting for the stock's future estimated earnings. By comparing two stocks using the PEG, you can see how much you're paying for growth in each case. A PEG of 1 means you're breaking even if growth continues as it has in the past. A PEG of 2 means you're paying twice as much for projected growth when compared to a stock with a PEG of 1. This is speculative because there is no guarantee that growth will continue as it has in the past. The PE ratio is a snapshot of where a company is, and the PEG ratio is a graph plotting where it has been. Armed with this information, an investor has to decide whether it is likely to continue in that direction. Now, for our favorite ratio, the dividend yield. I know everybody's scared of taxes, but we must remember that only way for an investor to gain value from a stock without selling is from dividend. So it is important ratio to take a look at. Investors usually will rush to buy dividend stocks when market crashes because they see this as a defensive stock. The reason for it is that dividend are always nice to have as backup when a stock's growth slows down. This is why dividend-paying stocks are attractive to many investors even when prices drop, because you get a paycheck every year from your stock. The dividend yield shows how much of a dividend per share you're getting for your money. By dividing the stock's annual dividend by the stock's price, you get a percentage. You can think of that percentage as an interest on your money, with the additional chance at growth through the appreciation of the stock. Always remember that dividend stocks can grow as well, because the companies that pay dividend don't pay all of them, they do retain some level of earning for future growth. For example, look at Microsoft, it has amazing track record of growth and pays dividend to shareholders. Although simple on paper, there are some things to watch for when investing for dividend. Inconsistent dividends or suspended payments, in the past, mean that the dividend yield can't be counted on. Dividends payouts also vary by industry, with utilities and some banks typically paying a lot where tech stocks, which often invest almost all their earnings back into the company to fuel growth, paying very little or no dividends. Investors must look into industry with slow growth and stable earning to find high-quality dividend stock like Coca-Cola and Bank of America. Finally, for the most famous valuation method, used by many hedge fund managers like Bill Ackman and Warren Buffett, which is the discounted cash flow model. The discounted cash flow model is another popular method of absolute stock valuation. Under the DCF approach, the intrinsic value of a stock is calculated by discounting the company's free cash flows to its present value. For the discount rate, usually investors will be using their required returns, let's say 10%, and a 2% on top of it because of inflation. But who knows what the future inflation rate will be? The main advantage of the DCF model is that it does not require any assumptions regarding the distribution of dividends. Thus, it is suitable for companies with unknown or unpredictable dividend distribution, for example, tech stocks like Amazon and Tesla. However, the DCF model is hard to use from a technical perspective. So newer investors usually don't use this method when valuating a stock. In investing, we must be aware of the risk and the price we pay for stocks. Hopefully this video help you guys to pick your suitable method of investing. Thank you for watching.